Welcome back, learners. I am coming with my ratio analysis part 2 again. Here we will learn about the introduction, your liquidity ratios, profitability ratios, activity ratios, and solvency ratios, and our summary. Here in this second part of the ratio analysis, we will dive deeper into the topics of the ratio analysis and its classification. Here we will understand the further classification of liquidity ratio, profitability ratio, activity ratio and solvency ratio with our practical questions. Liquidity ratio, as just a recap of that, your current ratio equals to, the current ratio is a widely used liquidity ratio that compares a company's current asset to its current liabilities. It is calculated by dividing current asset by current liabilities. Simple, current asset by current liabilities, that is the current ratio. Quick ratio is the also known as the acid test ratio, is a more stringent measures of liquidity that excludes the inventory from current assets. It focuses on assets that can be quickly converted into cash to meet short-term obligations. And your cash ratio is the most conservative liquidity ratio, is a measurement of company's ability to pay off its current liabilities or using only its cash and cash equivalent. It excludes receivables, inventory and other current assets. Now you see, we have to find out the current ratio is current asset by current liabilities. A higher current ratio indicates a better ability to cover short-term obligation. However, an excessive high current ratio may suggest that inefficient utilization of the asset. So, with this thing, your ideal current ratio is 2:1. That means your current assets should be 2 while your current liabilities should be 1. Means from the liabilities your assets should be twice. So that is the ideal current ratio. Suppose here in this example the current asset is 5 lakh, current liabilities is 2,50,000. According to the formula we have put out that current asset by current liabilities, that is 5 lakh by 2,50,000, current ratio is 2. So that is an ideal ratio. Now quick ratio is, the formula is what? Current asset minus inventory divided by current liabilities. The quick ratio provides a clearer picture of a company's ability to meet its short-term obligations without relying on the inventory sales. A higher quick ratio indicates a stronger liquidity position, and the ideal ratio is 1:1. Your current asset excluding inventory, it's given as 5 lakh minus 1 lakh, it is 4 lakh, and your current liabilities is 2,50,000. So the quick ratio is the current asset minus inventory divided by the current liabilities. So 4 lakh by 2,50,000, your after calculating it is coming as 1.6. So it is more than the ideal ratio, it is definitely good. The company is in the good position. Then the cash ratio, cash plus cash equivalent divided by the current liabilities. These are all hypothetical values. These are all the values that I have put by my own. The cash ratio indicates the immediate liquidity strength of a company. A high cash ratio signifies a greater ability to cover short-term obligation. Cash and cash equivalent is 1,50,000. Current liabilities is 1 lakh. So your cash ratio is cash plus cash equivalent divided by the current liabilities. So we have put it that cash and cash equivalent given in the example is 1,50,000 divided by 1 lakh. So cash ratio is 1.5. Next comes the profitability ratio, as it is gross profit margin. A recap of that, the gross profit margin measures the percentage of revenue that remains after deducting the cost of goods sold. It indicates the profitability of company's core operation. Net profit margin assesses the company's overall profitability by considering all expenses including operating expenses, taxes and interest. It indicates the percentage of revenue that represents the company's net income. Return on asset, that is ROA, you can write in the short form. Return on asset measures how efficiently a company utilizes its assets to generate profit. It evaluates the company's ability to generate earning from its total asset. Return on equity. Return on equity measures the return earned by the company's shareholders' equity. It assesses the company's profitability from the perspective of its shareholders. Now come to the practical example, that is the gross profit margin, revenue minus your cost of goods sold divided by the revenue into 100. A higher gross profit margin indicates the company generates more profit per rupees of sales or dollar of sales, you can say. It reflects the company's pricing strategy, production efficiency and control over production cost. So revenue is 1 lakh, 10 lakh, and your cost of goods sold is 6 lakh. So gross profit margin would be revenue minus cost of goods sold, that is your 10 lakh minus 6 lakhs divided by the revenue, that is 10 lakh into 100. So it is coming, as we are multiplying with the 100, so 40% we can write after calculation. Net profit margin, same. Net profit margin, the formula is net income by revenue into 100. So a higher net profit margin suggests that the company effectively manages its expenses and generates more profit from its revenue. It reflects the company's overall operational efficiency and cost control measures. So your net income is 2 lakh, revenue is your 10 lakh. So net profit margin is net income by revenue into 100. So 2 lakh divided by 10 lakh into 100, it is 20%. I hope you understand how to put the values. Very simple. It will be given in the question itself. Just you are to put into the formula to get the answer. Now return on asset. So return on asset, the formula is net income by total asset into 100. A higher return on asset indicates that the companies generate more profit for every dollar invested in the asset or every rupees that has been invested in the asset. It demonstrates the company's effectiveness in utilizing its resources to generate returns. Your net income is given in the example is 2 lakh, your total asset is given as 15 lakhs. So your net income, according to the formula, net income divided by the total asset into 100. So after putting the values, 2 lakh divided by 15 lakh into 100, ROA, that is return on asset, is equal to 13.33%. And return on equity, that is net income by shareholders equity into 100. A higher return on equity signifies that company generates more profit for every dollar invested or the rupees invested by the shareholders. It indicates the company's ability to generate favorable return for its equity investor. Example, net income is given as 2 lakh, shareholders equity is given as 8 lakh. So return on equity is net income by shareholders equity into 100. So 2 lakh divided by 8 lakh into 100, that is 25%. Isn't it easy? Next is the activity ratio. So activity ratio indicates that inventory turnover ratio, accounts receivable turnover ratio and total asset turnover ratio. So the inventory turnover ratio measures how quickly a company sells its inventory during a specific period. It assesses the efficiency of inventory management and the company's ability to convert inventory into sales. Accounts receivable turnover ratio indicates that or evaluates how effectively a company collects payments from its customers. It indicates the speed at which the company converts its accounts receivable into cash. Total asset turnover ratio. The total asset turnover ratio measures how efficiently a company utilizes its total assets to generate sales. It evaluates the company's ability to generate revenue relative to the value of its asset. Now, inventory turnover ratio, that formula given, cost of goods sold divided by the average inventory. A higher inventory ratio indicates that the company is selling its inventory quickly, which can lead to reduced carrying cost and better cash flow. However, an excessively high ratio may suggest insufficient inventory levels to meet customer demand. So, cost of goods sold, it's given as 5 lakh. Average inventory value is given as 1 lakh. So, inventory turnover ratio is cost of goods sold divided by the average inventory value. So, 5 lakh divided by 1 lakh, that is 5. Accounts receivable turnover ratio, net credit sales divided by the average accounts receivable. A higher accounts receivable turnover ratio implies that the company efficiently manages its credit and collection policies, resulting in a shorter collection period. Conversely, a low ratio may indicate potential issues with credit management or difficulties in collecting payments. So, your net credit sale is 8 lakh, average accounts receivable value is 2 lakh. So, account receivable turnover ratio, net credit sale divided by the average accounts receivable value, that is 8 lakh divided by 2 lakh, which ultimately dividing it comes as 4. Students, can you get me? Okay. Next is the total asset turnover ratio. So, total asset turnover ratio equals to revenue by average total asset. A higher total asset turnover ratio indicates that the company generates more revenue for each unit of asset employed. It reflects effective asset utilization and operational efficiency. However, a low ratio may suggest underutilization of the assets or inefficient operation. So, example of this, revenue is equal to it's given as 20 lakh and your average total asset is given as 10 lakh. So, revenue by total average asset is 20 lakhs divided by 10 lakhs, it is 2. Then comes the last part is the solvency ratio. So, here the debt equity ratio. So, the debt equity ratio measures the proportion of companies financing that comes from debt compared to equity. It evaluates the company's capital structure and the extent to which it relies on debt financing. Debt ratio. The debt ratio evaluates the percentage of a company's assets that are financed by debt. It provides an overall assessment of the company's indebtedness and financial risk. Interest coverage ratio. The interest coverage ratio assesses a company's ability to meet its interest payment obligation. It measures the company's ability, sorry, companies extremely sorry for that. It measures the company's ability to generate sufficient operating income to cover its interest expenses. Example, a debt equity ratio, total debt by shareholders equity A higher debt to equity ratio indicates higher financial leverage and a greater reliance on debt. It signifies higher financial risk and may indicate potential difficulties in repaying debt obligations. Conversely, a lower ratio suggests a low level of debt and a more conservative capital structure. So, here in this example, total debt is given as 8 lakh, shareholders equity is given as 12 lakh. So, debt to equity ratio is total debt is 8 lakh divided by 12 lakh, it is 0.67. Next is the debt ratio. Debt ratio is equal to total debt by total asset into 100. A high debt ratio indicates a higher level of debt relative to the company's asset, which implies higher financial risk. A lower debt ratio suggests a lower level of debt and a stronger financial position. Total debt again given 8 lakh, total asset 20 lakh. So, debt ratio, total debt is 8 lakh by total asset it is 20 lakh. So, debt ratio is 0.4, 0.4. Interest coverage ratio. The interest coverage ratio is equal to EBIT divided by the interest expenses. EBIT is earning before interest and taxes. A higher interest coverage ratio indicates a higher ability to cover the interest payments with operating income. It signifies a lower risk of defaulting on interest obligations. A lower interest coverage ratio suggests a higher risk of financial distress if operating income is insufficient to cover the interest expenses. Examples has been given: earning before interest and taxes, that is 5 lakh, interest expenses, that is 1 lakh. Solution: interest coverage ratio is equal to EBIT by interest expenses, which is 5 lakh by 1 lakh. So, obviously the interest coverage ratio come as 5. Total summary of this presentation reinforces the various classification of the ratios. It encourages the audience to exercise caution in interpreting the ratios, consider industry benchmark, and continues exploring and applying ratio analysis techniques for a deeper understanding of financial performance. So, thank you. That's all I need to say in this video. Thank you once again.